People tend to complicate investing, and in my experience, it's done for a couple of reasons. One, they're a stockbroker, and the more complex they make it sound, the more they make you feel like you need to pay them for their services. Another reason people tend to complicate investing is due to inexperience, right? They just don't know any better. Another reason people tend to overcomplicate investing, especially now in this day and age in social media, is because the more complex they can make it sound, the more likely it is that they'll be able to sell you one-on-ones or sell you a course or make you join their private paid Discord or one-on-ones because, God, it really does feel so overwhelming. And in fact, any time that I make a video on social media about investing and how really you can simplify it and keep it easy, someone in the comments inevitably pops up and says, well, here's why you're wrong, and you forgot this, and you didn't add that. When you're new to investing, the easiest thing you can do is buy a broad market S&P 500 index fund. But immediately, when I make those videos, people in the comments try to overcomplicate it, going, well, what about speculative? What about tech? What about banking? What about overseas and international? And immediately, it's gone and gotten complicated. The average investor really only needs a few investments. I'm going to probably put pictures there if I can figure out how to do it. An S&P 500 index fund has a historical rate of return of around 10.5% per year on average. This is another thing people love to fight about in the comments. They go, 10.5%? Not every year. Last year it was down. Yeah, last year it was down. Other years it's up. Some years it's up a little bit less. Some years it's up way more than 10.5%. And then they take all of those numbers and going back to the inception of the S&P 500, and they create an average number. And that number happens to be around 10.5%. S&P 500 index funds are a great investment for new beginners. It's just a great investment for anyone who doesn't want to pick individual stocks, who doesn't want to overcomplicate things, who doesn't want to worry that they've bought the wrong thing or they went, say for example, very heavy into all tech stocks. And then like we're seeing right now, tech stocks get crushed. They didn't have a diverse portfolio. They went very heavy into one thing. That's a little risky. So for someone who wants a hands-off approach, a kind of like old school set it and forget it kind of approach, a broad market index fund is great. The next thing you could do if you wanted was to get something like a dividend paying ETF. ETFs, by the way, it's an exchange traded fund. So it's not a single company, it's like a basket of stocks. That's what everyone always says on social media. It's like a basket of stocks. There are two different kinds, actively managed and passively managed. Passively managed ETFs are ones like these broad market S&P 500 index funds. They just buy everything that's in the S&P 500. It's easy, it doesn't require a lot of active management. Actively managed funds are ones where someone is actively picking what stocks to put in it, and you pay a higher fee or expense ratio for that privilege. A lot of people think that actively managed funds can possibly perform better. Some people think they perform worse in different markets and different economies. One might do a little better. Again, even here in this video, it's getting overly complicated. An S&P 500 index fund and a dividend-paying ETF are really two great options for people who want a hands-off approach. They don't want a lot of involvement in their investments. That's great. If you decide down the road that you want to become more involved in your investment, then you can start looking at ETFs by sectors. You can start looking at individual stocks, speculative investing. But for most people, picking a couple of ETFs is perfectly fine. Another mistake that I see a lot of new investors making, in addition to overcomplicating things, is buying at the wrong time or selling when everyone else should be buying. Panic selling. Markets are down right now. Oh, I made a mistake. We've seen a lot of new investors in the last couple of years, whether it was because of AMC and GameStop bringing people in, or crypto bringing people in, or stimulus checks bringing people in, or everyone was at home during COVID, so they started going on TikTok and watching people like me, self-taught, self-employed stock traders. Whatever the reason, we started seeing all these people come over to investing. And essentially what they were doing was buying at all-time highs. And now markets are down and they're freaking out. Keep in mind that if you were to go back to 2008 and start investing back in 2008, you would probably have felt the same thing, right? Ease, not ease, angst. A feeling of like, oh my God, what have I done? Why did I do this? I bought at the worst possible time. Investing isn't for me. I'm out. Smart investors rushed in because they saw opportunities. No one's trying to time the bottoms here. No one's really trying to guess. Let's say there's a stock, it's $50, it drops to 30 or 20, and you buy it with a 10 or 15 year window that you want to hold. And that stock drops another $10 after you bought it. You don't really care because you're a long-term investor. Maybe even if you like the company so much, you average down and buy a little bit more. Maybe. The point is not trying to time things, not trying to wait for the bottom. You don't know when it's coming. If you're a long-term investor and you buy something that's a little bit more expensive and it drops, hey, no big deal, right? Because you have a 15-year. Who cares if the stock drops another 10%? If in a decade it could go up 300%, right? So zooming out really is the best approach for new investors. Another mistake that I see a lot of new investors make is that they don't reinvest their dividends. They see that cash coming in their account every month and it looks so small and so inconsequential that they don't want to use it. Or maybe they've bought really large positions in companies and the dividends are a pretty decent amount of money and they go, oh my God, I'm getting a dividend of $600 a year. I can use that to cover an expense or pay down a debt or something like that. Which on one hand, okay, fine. But on the other hand, you're missing out the benefits of long-term compounding. Taking that $600 and putting it back into the stock allows you to build a larger and larger position over many, many years. So the point of this video is don't overcomplicate it. Don't overthink it. When you go into the comments in social media and someone says, like me, buy a broad market S&P 500 index fund, and the comments are loaded with like, well, what about overseas international stocks? And what about this? And what about that? It's not really relevant to most investors. If you're new, or if you aren't new, but you really just don't want to be involved, waking up every day and checking each individual stock, don't worry about overcomplicating it. Keep it as simple as possible. If you thought this video was helpful, my name is Kenneth. I teach people how to trade and invest in stocks. I've been trading for over 13 years and investing for more than 20. I have 200,000 followers on TikTok. That's where most of my videos are, although I do upload some here and on Instagram and recently on Facebook. If you thought this video was helpful or useful in any way, share it, hit the follow, hit the subscribe, hit the buttons. Thanks for watching and have a good day.